I think we'll go ahead and start. Um, I welcome everyone to the October 15th Baldwin Investment Management webinar. The topic, which probably everybody's been anxiously waiting for, is tariffs. As Peter has titled the uh, essay, for lack of a better word, "Who's Got the Check?" His commentary that was on our website this month, and it's a very relevant view of the situation with the tariffs, what to expect, and where we are in the cycle. I'm going to make a few remarks at the beginning, but before we start, Gail, can you uh, appraise everybody of what we've come to call the rules of the road?
Yes, I sure can. Let me just pull up my screen for a quick moment. Just bear with me. It seems like I have lost my share here. I'll be with you all in just a quick second. It looks like I lost my ability to share.
You want to do a summary
Okay.
for us then?
Yeah, sure. Okay. You should be able to see the mute. Can you see the mute page at all? Okay. All right, I think I might be back. And again, so sorry about that. Okay. Well, it looks like I don't have the share feature, but I will just go over quickly the rules of the road as they haven't changed. We do ask everyone to keep their mics on mute to minimize background noise. If you have any questions during the discussion, continue to stay on mute, and we will definitely answer your question. Also, too, if you would like to raise your hand with your question, please select the reactions or the react button at the bottom of your screen, and I will take note of your question and present it to both Richard and Peter. Also, too, if you're joining by phone, please dial *9 to bring you in the queue. I will definitely take a look at that and bring that question both to Peter and Richard. And if you prefer to ask your questions through the chat, please feel free to do that. And again, your question will be presented. So that pretty well much covers the rules of the road, and I will review the Q&A further in the conversation.
Thank you.
You're welcome.
So I've tried to, Peter and I have discussed how to frame this phone call. I'm framing it with two language riddles, if you might, if you will. The question I'm asking at the beginning of the call is, why is there no Y in tariff? There's no Y in the word tariff, with the emphasis on the WHY. And then we'll end with a riddle, is why tariff has two Fs. We'll get to those later on. That's an attempt to add a little bit of levity to what is a fairly dry topic, but Peter and I will try to make this lively. It is a presentation on tax, which is a tariff, and I'm going a little bit into history. The tariffs have been around in this country since the beginning of the dawn of the United States, and there were three main stages in tariffs. In the earliest version of tariffs, they were really more of a revenue tax, bringing in revenue for a newly created country, which was trying to get itself on its feet. After the Civil War, it was more of a restrictive tariff, trying to protect American industries while the country was recovering from the Civil War. And then after the New Deal, after the sort of the culmination of that period with the Smoot-Hawley tariffs of the 1930s, tariffs started a slow and protracted decline all the way to just about the middle of the last decade. The first Trump administration did a little bit in the tariffs, and we've seen obviously quite a bit more in the second Trump term. So I was going to ask, Peter, would you sort of take us through what's happened in the last 2 years and the implications that it's had for inflation, among other things?
Sure, be happy to. Welcome all. Good to see you again. So two headline points that we want to make in this presentation. First, that ultimately consumers are going to pay the lion's share. Let's further define that. American consumers are ultimately going to pay the lion's share of these tariffs. No matter what anybody says coming out of Washington, it's going to be the American consumer. Not immediately, that hasn't been the case. We'll go through that a little bit, but as these tariffs hang around longer and longer, more and more of that cost is going to get shifted to the American consumer. And the second point is the biggest beneficiary of all these tariffs has been the federal government. And here we see on this first chart that the federal government is really collecting quite a bit of money. And so much money, in fact, that S&P in a recent review of American credit decided to maintain its stable rating. The United States is a AA rated credit risk, but it had a negative outlook, and in fact, S&P maintained its credit rating at AA without a negative outlook because of all the money that the federal government is bringing in with these tariffs. So essentially, what has happened recently is that the one big beautiful bill that we all remember got passed in the springtime. There were very few tax cuts in that bill. If you were a waiter or a waitress and you got tips, you got a tax cut. But really the main thrust of that bill was an extension of the 2017 individual tax cuts, which were due to expire at the end of this year. And the Republican Party did not want those tax cuts to expire. That would have been quite a large tax increase on the American economy. So while no large tax cuts, really there were nothing more than tax extensions. But as we all know, we've talked about this quite a good bit over the past few years. We're running some pretty handsome deficits and building up quite a debt load. The US government needs to find new sources of revenue. And so a primary goal of these tariffs is to generate a lot of income for the federal government. And that money, one of the possible uses, and it's been talked about quite often, is to reduce our debt. So what the US government did was they swapped out an income tax for a sales tax. They swapped out an income tax for a tariff, which is nothing more than a sales tax. So that's one of the big headlines coming out of this discussion today. As you can see, collecting a lot of money, the effective tax rate, tariff rate, if you will, coming into this year was about 2.4%. We did have some tariffs, but few and far between, and not many of the imported goods into this country were tariffed or taxed very highly. Well, the effective tax rate now is about 10 to 11%. So you can see that that's a rather smart jump as far as the tax rate goes. So that's not the only cost, however, connected with tariffs. Gail, if we can go to the next slide. what you see here are new requirements. So this is regulatory red tape. So if you're an importer bringing goods into the United States, there are all sorts of forms that have got to be filled out. There are all sorts of calculations. There's all sorts of investigations. The authorities will presume if you're importing a particular good that contains, say, aluminum in the good, they're going to presume automatically, unless you can specifically identify where that aluminum was smelted, they're going to presume it's from Russia. And being from Russia gets hit with the highest import tariff. It could be imported from Jamaica, but you've got to, as the importer, you've got to positively identify that the aluminum that's used in the mixer that you bought was smelted in Jamaica. Otherwise, they're going to presume it's from Russia. So you see all these various boxes on this chart here. And this just identifies some of the tariff paperwork that importers have got to go through. So while I think one of the unsung or unnoticed or hard to measure really very big benefits of the current economic plan that's being pursued in Washington, and that's the reduction in regulation, the reduction in bureaucratic paperwork to make business run more smoothly. That's having a very beneficial effect on our economy. But this, to some extent, counterbalances that, because while they're cutting rules and regulations in certain areas and lowering costs for business to do business in many areas, they are increasing it in this area. And so this is another cost of this tariff program. If we go to the next slide, Gail, you'll see here, this is the result of audits. So, business people aren't just going to readily sort of accept everything, these new rules. They're going to try and find ways around the rules as legally as possible, hopefully, but they are going to try and find ways around. And when people try to find ways around, when they try to escape a tariff or a tax or another cost, well, that's when people say, well, I think we need to audit this. We need to review the filings. And you can see as a result of all these audits that have been going on, this is the source is the U.S. Customs and Border Protection Agency. They're collecting a lot of money from these audits. So they're capturing a lot of this stuff. They're not letting these business people get away with it.
Peter, can I make a couple of comments before you go to your next slide?
Absolutely.
You had mentioned that the Yale Budget Office had concluded that the present tariff rate was between 10 and 11%. Just in the last about week or two, they've come out with some projections of where they think the tariffs are going to end up when they're all fully negotiated and in place. And it's a surprisingly high average rate of 17.9%. So when you mentioned that the starting point was 2%, taking it up to 17.9% is an increase of almost 15%, or it is 15 points, not just an increase of 15%. They then expect changes in consumption patterns to take place because of these tariffs. Sort of the butter to margarine substitution or the liquor to beer substitution, where somebody might move from a highly tariffed item to a less highly tariffed item. And they expect even after those shifts, the rates to be 16.7%. Then they further went along and said what effect, this is pertaining a little bit to what you're still going to present, what effect is that going to have on real growth, on employment? And they're concluding that real growth will approximately be 0.4% lower because of tariffs which is about $125 billion. That's growth that disappears from the economy. Unemployment is expected to be a little bit higher, but not dramatically higher, a little 0.3% higher over the next year or two. So they expect marginal effects on employment, but some real growth penalties for the U.S. economy, and probably because their tariffs are affecting overseas producers as well, probably a little bit lower global growth as well. So I thought that was significant to point out before you went on to your next topic.
Those are all very good points, Richard, and I think spot on, because we have been working in a world where there have been very, very low trade barriers, in the form of tariffs and rules and regulations. And that has allowed international commerce to prosper. Whenever you introduce new rules and regulations, whenever you introduce a tariff, it's like throwing sand into the gears of a well-oiled machine. Now, things aren't going to run so well. Logistics, supply lines are going to move. Consumers are going to make different choices. Productivity is going to have to get recaptured in another form. When we went from a high tariff world many, many decades ago to a very low tariff world, what we've just gone through recently, that enhanced productivity around the world, enabling costs to be driven down. So a consumer could search for the lowest cost mug. Who manufactures the lowest cost mug in the world? Probably somebody in China or Vietnam. Who manufactures the lowest cost electric vehicle in the world? Probably somebody, again, in the Far East. But that was the benefit of a low tax world. You could price discover around the world. That was now your new marketplace, your new manufacturing plant. All over the world, you could find the lowest cost. We introduced tariffs, we introduced new rules and regulations. You inhibit that. Now people are going to shift, and they're going to, you're being encouraged actually to maybe, okay, I have to now buy this in the United States, which is a higher cost manufacturing horizon. So those are all very good points, and that's what we're going to be faced with. If we go to the next slide, Gail, please. Here we see another example of supply lines changing. So this is trade rerouting or rerouting to avoid higher tariffs. You can take a look at the share of China exports to Cambodia and Thailand and Vietnam. It's the blue line. And then you can take a look at the gold line, share of US imports from Cambodia, Thailand, and Vietnam. You can see that the share of imports from those countries has now recently gone over the share of exports from these countries. And that's simply because people are trying to find a new spot to buy stuff.
Does it mean that their trade is just being rerouted, or is there some assembly or something being done in those countries?
It's both. There's assembly, so there's product coming out of China that is now being
repackaged or reassembled.
Yes, in Thailand or Cambodia to avoid the Chinese tariff. So they're saying, oh, well, this product really did originate in Thailand, or it really did originate in Cambodia, but it really didn't. It originated in China. Now the Border Patrol, if you will, has awakened to this, and so now they're digging even deeper into an importer has to have much clearer proof of where the product originated. And if they find that you're hiding that stuff, hiding that information, they'll slap an even higher tariff on it. So there's some real penalty connected with it. So how are companies coping with all of this? Well, as we look at and right at the moment, let's just confine our discussion to big publicly traded companies. These are the sorts of companies that we trade their stocks. So these big, actively publicly traded companies are handling, are coping really quite well. And I think that has surprised a lot of analysts on Wall Street. Well, how are they able to cope so well? How are they able to take on all these tariffs and the confusion and yet still report surprisingly good earnings? And I say surprisingly good earnings because they have surprised Wall Street analysts each and every quarter so far this year, despite the imposition of these tariffs. And very, very early days so far in the third quarter earnings reporting season. But even what we've seen so far, stronger than expected earnings. So, first, number one, the headline duties that we all see in the popular press, China gets slapped with a 50% duty on this, and Brazil gets slapped with a 50% duty on that. Those are really not accurate. Those are not the effective tariffs. Canada gets slapped with some 35% duties. Well, 90% of the product that gets exported out of Canada into the United States is covered by the USMCA treaty. This was a treaty that was put into place under the first Trump administration. So very little of Canadian exports gets taxed at a 35% rate. Most of the Canadian exports come in at zero tariff. So what you see in the popular press is not entirely accurate. Second, lots of companies are adjusting their supply lines. They're moving from China. They're going to Vietnam. They're going to India. They're going to Laos. They're going to Cambodia. They're going somewhere else. They're not just sitting back and taking it. We've already discussed that on this slide right here. The authorities, as I said, are wising up to that. But the big companies who have the infrastructure to switch supply lines will switch supply lines to lower their tariff exposure. They're also adjusting other operating expenses. One of the geniuses of American management, and I've certainly been very impressed with it, is all the levers they've been able to pull over the last year to meet their numbers, if not exceed their numbers, at least as they are being projected by Wall Street. So they are working very hard, and we pay them. We as shareholders pay these people a lot of money. So we expect them to work whatever levers they've got to keep the company profitable, to maintain their margins. And so far, they've been successful at doing so. And then finally, some companies have announced that they're going to raise prices. Nike has announced that. Walmart has announced that. Nordstrom's has announced that. And the list goes on and on. They're reluctant to do that. First, they don't want to lose customers. So they're in the immediate time, they have been willing to take a bit of a hit on their margins because of the tariff. They're working other expenses to maintain their margins, but they've taken a hit on their margins with regard to tariff because nobody's sure right now how long this is all going to go. Originally, when tariffs were being discussed, It was a negotiating position. I'm going to slap a tariff on you because you got a tariff on me. Now, if you agree, you France, you the EU, you Japan, if you agree to lower your tariffs to zero, we'll lower our tariffs to zero in the United States. Well, that seems to have gone off the table now. Now it seems to be more the instance where people are we're going to be able to get into their markets, but they're still going to for no tariff. But yet we're going to charge a tariff on imports of Japanese goods, say, or Korean goods. But nevertheless, some companies are saying that, well, at the end of the day, we're still going to raise prices. Now, the American consumer is not going to take 100% of the tariff increase. The importer is going to take a share. It's not determined yet what the share is, but they're going to take something. The exporter, the Chinese manufacturer, the Korean manufacturer, the Mexican manufacturer, they're going to take a share, but that's not going to be the big share. I've seen various reports where it's like 10 to 15%. They're going to take that. And they'll do that by lowering the price of their export to share in the pain, if you will. The importer will take, something like around 20 to 30%, I've seen. And it's going to be ultimately the American consumer that's going to take the lion's share. Well, we might then go on to the next chart and say, well, how's the American consumer coping with all this? We've just discussed how American businesses are coping. They seem to be coping pretty well so far. And let me just underscore so far. We don't know how it's going to be in the future. There are too many variables out there. But so far, businesses have been able to cope. Gail, could you please go to the next slide?
Yes, and Peter, before we go to the next slide, there are 2 questions in the chat. Can I post them to you first before we move forward?
Oh, absolutely, sure.
Okay. The first question, as well as a comment, is from Liz, and she wrote, what are the positives of tariff approach to drive revenue? Aren't we creating tariffs that are similar to what our U.S. companies are being charged? Perhaps a consumption-based tax increase via tariffs might drive the burden toward wealthier buyers, drive consumers to buy U.S. So that's the first question from Liz.
Let me try that first, Peter.
Sure.
If I may. I think obviously the tariffs are one of many factors that are going to influence what a whole lot of things are going to end up over the course of the next year or two. The immigration enforcement's a big factor that might have some bearing on not only GDP, but also prices as well as unemployment rate. The tariffs will encourage, I think, some foreign manufacturers to start at least making commitments to build facilities in the U.S. So that's very positive for both employment and for bringing some of that manufacturing back. That's obviously not going to happen quickly. It takes years to establish and then staff a new fab plant or something like that, but it's a step in the right direction. I think the attention to this is positive in the fact that I think more and more people are trying to buy American goods, whereas before it might have been kind of unclear whether they were buying foreign or domestic goods. And I think there's a real sort of a more strident patriotism that may be encouraging people to buy American even more than before. But obviously it's the tariffs are one of many factors that are going to influence unemployment, GDP growth, inflation. And that's part of the uncertainty is how does AI relate to the tariffs? The tariffs is a drag, but AI is a boost. The enforcement immigration is a drag, but the inducement to invest in the U.S. is a boost. Both fiscal and monetary policy are now kind of boosting production. Interest rates are falling, and the revenue that's been brought in by the tariffs is a little bit of an offset to the continued giveaway with the big, beautiful tax bill, which, as Peter pointed out, it wasn't a tax reduction, but it was a avoidance of going back to the 2017 rates, which were considerably higher. So it was a negative tax increase, not actually a tax reduction, but an avoidance of a tax increase. So that the tariffs are a bit of a supplemental income that counterbalance that. So there are just a new number of items that are going to influence the way we're heading. Peter?
Couldn't have summarized it any better myself, Richard. I think that was expertly done.
Thank you.
So what is the
Also,
second question?
Yes, the second question is from Kathy. The question is, don't you think that unemployment will rise more than 0.3 when you add in the impacts of AI?
Oh, well, hard to answer that question right at the moment because we're too new into AI. I do believe that we're going to see the unemployment come first, and then the reemployment as AI is spread throughout the economy, and thus that new technology creates new jobs. That will come second, but we will suffer the unemployment downturn first. Remember what happened with the advent of the internet. People were scared to death of that and thinking it was going to displace an awful lot of workers. It did for a while, not for a terribly long while, but it did for a while. There were jobs that were lost because they were no longer needed. But new jobs got created because the internet opened up parts of economies that we hadn't even imagined at that time. So people got reemployed. And if you look at the back a couple of charts, we've got the unemployment rate in the United States today, and it's at historically low levels. It's not at the absolutely lowest level that we have experienced recently, but it's still at very, very low levels. We're lower than what the Bureau of Labor Statistics would define as full employment. So I think we here are in the camp of not fearing AI at all, but willing to embrace AI. Yes, certain jobs are going to get lost in the immediate term, but more jobs will be created in the long term.
Well, let me add one other thought to that. This is a popular topic today. We've been reading about this the last 2 weeks. There's some speculation that rather than fewer people working the traditional 5-day work week, we'll have the same number or even more people working a revised 4-day work week, so that the advantage of AI will be a 3-day weekend. I love the concept of that. Maybe it's just because it sounds so pleasant. But wouldn't that be a wonderful result of AI giving everybody an extra day each weekend?
Is that it for the questions right at the moment, Gail?
I think so.
That's
Looking
it.
at the
That's
number.
it.
All right, could you go on to the next slide then, please? So how is the American consumer coping with these tariffs, since we've asserted that at the end of the day, it's going to be the American consumer that's going to foot most of the bill? Well, we've commented over quite a few of our commentaries over the last few years about how strong the American consumer is, the balance sheet of the American consumer. It continues to be very strong. Stocks have gone up, real estate values have gone up, unemployment, which you'll see on the next chart, is low. People are employed. And from the Bank of America Research Institute comes a lot of what I think is very interesting work. And they're looking at their client base, which is, I can't remember all the numbers, but it's like 70 million accounts and $7 trillion worth of assets, and et cetera, et cetera. But we all know Bank of America as being probably, I think it's the second largest bank in the United States. They look at not what the consumer is saying in various surveys. We quite often see the Michigan Consumer Sentiment Survey, and there's a consumer survey put out by another entity also. And right at the moment, they've been very dour. People are not happy, at least they're expressing that in various surveys, but yet they're still spending money. And that's the big point that Bank of America Research Institute makes in their most recent studies. While consumer sentiment may not be terribly high, because people are employed, they are spending money. They want to spend money. They're not feeling so bad that they're not spending money. So even though they may say to a pollster, I don't feel so good, I'm still going out to dinner. I'm still buying various things at the stores. So, and the reason they feel that way, I think at their core, is because their house has gone up in value, their 401k has gone up in value, they're employed, they're earning money. So when they look at their own personal balance sheet and personal financial situation, they sit there and say, we can afford to do this. So they're keeping our economy going along quite strong. Now, no consumer wants to pay an increased cost. Absolutely. No consumer says, oh, well, I would willingly pay a tariff on this product that is being shipped over here from China. They're not willingly doing it. They grouse about it, but they're still buying it. Inflation continues to be under control. This is a chart of inflation. You can see the huge spike that we had back in 22 to 23. And then you can see it come down. And it's basically as it has been for quite a long period of time. So inflation, despite there's an awful lot of worry about inflation, inflation still seems to be pretty well controlled. It's not down at the Fed's magic level of 2%, but it's close to it, and it seems to be trending that way. And coming out of the most recent Fed meeting, the Federal Reserve governors seem to be more concerned about unemployment and the labor situation than they are about inflation. And thus we've had our first cut in interest rates. And we've had further signals that at future Fed meetings, interest rates will be cut again and again, and perhaps a third and a fourth time early in the next year. So consumers' balance sheet is in good shape. The consumer, Gail, could you go to the next slide, please? The consumer, as you can see here, is employed. This is the unemployment ratio in the United States. And you can see it is at historically low levels. So the consumer's employed, consumers earning money, consumers' balance sheet's in good shape, got very little debt, assets have gone up in value. I'm going to grouse about paying a higher cost any day of the week. I'm going to grouse about that, but I'm still going to be buying because I'm in pretty good financial shape.
It's interesting, Peter, just to make a point on that unemployment. I saw an interview with Jerome Powell just yesterday, and he was talking about that the labor demand and the labor supply have both declined. And I was trying for various reasons to fit. I can understand the demand part of that because there's some uncertainty and maybe there's not new hiring. So we're hearing there's less firing and less hiring. But why would the supply of labor suddenly have gone down? Any theories of that? Admittedly, they're immigrants that are not in the labor force anymore but I'm not sure they were counted in the labor force anyway.
Well, I do think that's a part of this puzzle because um, um, more and more people are getting deported, or they're not showing up at work because they're scared to death that they're going to be swept up off the streets. So those are two things. And number three, just our demographics. I mean, we have been in an economy now for quite a few years where our population is aging. We're not producing enough babies. And so as a consequence, the available pool of labor is shrinking. And this has been cited by a number of economists that it's starting to become a problem, and it will become a huge problem in the future because we're just not going to have enough workers, especially as compared to the number of retirees that we've got. And this is one of the main problems with Social Security and why it's not going to last, because you've got a shrinking pool of workers, people who are going to be productive, people who are going to make money and pay some sort of a tax to the fund. And you've got an increasing pool of retirees. So I don't know that maybe it seems a little sudden because of people with the deportation issues and people not going to work because they're scared of being swept up. But this has been a long-term problem, and it's not getting any better. And that's why the advent of AI, the only way we're going to get ourselves out of this situation is to become much more productive, use fewer workers, but each worker produces a lot more than they used to produce. And that's where technology comes in.
And that's a very credible growth story for this, not just for this country, but for the whole global economy, is the productivity picks up where the labor supply leaves off.
Absolutely. It's a very credible growth story.
We also might be seeing some of these 57-year-old government employees, instead of going to work for Home Depot or going out and picking mushrooms in the mushroom houses, maybe they're actually retiring, taking their 25-year retirement rather than the 30-year retirement that they were hoping for.
Well, I'll bet you some are certainly doing that, but I'll bet you some are also saying, gee, I don't want to retire right now. Let me start up a new business. I've got all this experience and knowledge having worked at the government in whatever task it was. And maybe what I can do is I've always thought this was an issue or a problem, and I'm going to solve it. I know how to solve it, so I start a new business. Perfectly reasonable.
And then actually we have seen a resurgence of business startups as well.
Mm-hmm.
That's consistent with that.
Yep.
Interesting. Well, I can't wait for you to throw up the last chart, because I've been trying to figure it out since you first presented. So are you ready to talk about your last chart yet?
Sure.
Gail, let everybody else share this, and you can explain this.
Okay, so what this is looking at is the S&P 500 over a fair amount of history since 2007 to present day versus Federal Reserve interventions, i.e. when they cut interest rates or when they raise interest rates, and what happens to the Fed funds rate and the 10-year yield. And basically the story that's being told here is that we have been, if the chart were to go back even further, you would see interest rates at a much higher level. So the Fed funds rate and the 10-year, if you go back into the 70s, they were at a much higher level. So we've been in a declining interest rate environment for many a year, and the stock market likes that, and as a consequence has risen over quite a few years. Now, all we're showing at the very tail end of this is here we're seeing the beginnings of interest rate cuts. Remember, Mr. Powell and the Fed cut interest rates beginning last year and then stopped. They did a couple of cuts, and then they hesitated. They wanted to take a measure. Let's just see how this is going, see what its effects on the economy were. And now they've decided, well, we've got some room to cut again. So the point of this is that interest rates are going down. They have been cut. They're going to continue to be cut according to the most recent Fed meeting. And this should be supportive of the stock market. And those are all my charts.
Well, let me take the floor for a minute, give you a chance to catch your breath and talk about a seminar that they had at the Peterson Institute, which is located in Washington, D.C. It was a formed by Pete Peterson, who I believe was Nixon's Secretary of Commerce or Interior, was it Commerce?
Yes.
And was a little bit right of center. I'm not sure that his institute has stayed there, but he was perceived as slightly on the conservative side, very concerned with deficits, as we all are. But the presentation that I saw had two economists, Karen Dinan, who was a U.S. economist with a great deal of credibility. She had a resume that was pretty darn impressive, and she sees inflation staying at or even below 3% going forward. She sees the wealth effects in the increased market averages and home values, home equities, insulating us a bit from the tariff drag. She sees the monetary and fiscal stimulus as offsetting some of the other negatives, and thinks that the inflation is pretty well anchored. So although she expects rates to stay at about 3% for a while, she doesn't expect it to soar. And that's pretty consistent with the message that I think some of your charts portray. We don't really know yet, but she suspects that it's not going that high. On the other hand, and remember, was it Truman that said if you get two economists, or he wanted a one-handed economist, as the economists always say, on the one hand, on the other hand. Well, Adam Posen is president of the Peterson Institute, and he thinks inflation's going back to 4.5% or higher by the end of 2026. And he cites a couple of things that are going to cause this to happen. He thinks the macroeconomic outlook is inflationary across the board. He thinks monetary policy is going to fan the flames of inflation, and he does not think inflation expectations are anchored. And I think by that, you and I had a discussion, Peter, recently about whether it's just a one-time increase in the price level and inflation stayed relatively low, or whether it was the beginning of sort of a wage price spiral like we had in the 70s. And I think it remains to be seen what it is, but Posen thinks the anchor's not there, and that once inflation starts up, it's going to go into this cycle, just like it had in the past. I'd be interested in your thoughts about whether Miss Dinan is correct or whether Adam Posen has a point.
I think Posen's got a point, but I'm going to side with Dinan. I think what's very hard to measure right at the moment are all the beneficial effects of less regulation. Economics as a science is not well equipped to accurately measure the effects of taking regulations off the books. We can, economists can infer, they can sort of get a sense, but it's very hard to put down a measuring rule and say, okay, this is exactly the direct effect of all this bureaucratic red tape being sort of wiped out here and freeing up business to do what business wants to do. So we're not going to know until we know. we're going to have some experience with this for a while. Certainly, when you see a 50% tariff being slapped on a country from which we import goods be the headline in a paper, the only thing that people remember is 50%. And they don't think about, well, counterbalancing that. And number one, that's really not the effective tax rate because of all the loopholes and the other agreements that we've got, which basically exempt 90% of the goods that we're importing for from that country. What we don't have a good handle on is all the other things that are going on in the economy. Our economy is a very dynamic economy. There are lots of puts and takes, and as a consequence, a lot of those dynamic puts and takes, if you will, can't be measured readily, and so we can't readily offset the 50% number with a down 25% number. The only way we're going to get there is we're going to experience it. I think that's one of the things that people are a little bit scared about as far as AI or technology in general. At the very first, when a new technology gets implemented, we don't see the effects in hard numbers. We have to experience it for a while. We have to learn about it. We have to start implementing it. And then as we implement, we perfect that implementation. We find new ways to implement it. And then we hone it. And then finally, after a couple of years of experience, maybe it's as long as 5 years worth of experience, we really see all the beneficial economic effects of it. And so I think it's too early to tell what some of these other beneficial effects are going to be, but I do think they provide a great dampening influence to inflation. Tariffs are definitely, whatever the final tariff number is, the effective final tariff number is, that's going to be a step function up as far as cost goes. It's not reflective of the rate of change in prices. That's inflation. So once that step function has been accomplished, that's the new price. The price is no longer 15, it's now 20. Okay. But unless the tariffs change all over again, that could happen, but let's say that's not what we're slated to have happen. The rate of inflation shouldn't change.
Yeah, I mean, it's that same argument could be applied to any particular item. Let's say a dozen eggs costs $4. And would the average consumer be more upset if the price immediately went to $5 and then increased each year by 3 cents? Meaning that the price level is higher, but the inflation is almost non-existent, rather than the price going up 8 to 10% a year with kind of no end in sight. And a lot of us lived through the 70s, and we did experience a wage price spiral in the 70s. The inflation first went to 6 to 8%, then it went from 8 to 10, and finally ended up 10 to almost 15% inflation. And it took a really tough love from Paul Volcker to really upset the apple cart on that inflation, or we might still be having the inflation of the 70s in place.
Exactly. I think people are better able to handle a jump in price, and then you annualize that a couple of years down the road. You sort of forgotten that you had that big jump. You're now used to the new price level, and you're seeing that new price level isn't moving very much on an annual basis. You sort of sit there and say, okay, fine, I'm okay with this. So I think they're better able to handle that.
And I think that's precisely Adam Posen's worry, is that increase becomes kind of a stimulant, and that basically it starts asking workers to demand a 20% increase to cover the cost of their new dozen eggs. And then companies start asking for setting prices higher to cover the cost of their employees, et cetera, et cetera, et cetera. So we will see how well the inflation is anchored probably over the next year.
But when you take a look at a basket of goods, not every good in that basket is going to go up in price. Some items in that basket, and let's not just look at goods, let's also look at services, because we are largely a service economy right now. We spend more money as consumers on services than we do on goods. When we were, back in our earlier days as a country, we spent much more of our hard-earned dollar on goods, not on services. Exactly the opposite. So if you take a look at the whole basket of what somebody is consuming, goods and services, with the advent of new technology dampening the price of services, service prices could go down, some goods prices could go down, other goods prices could go up. So the rate of inflation, might not move at all.
When I was in undergraduate years taking economics, we viewed equilibrium, or should I say the discipline viewed equilibrium as 4% inflation and 4% unemployment. But we're below, I guess employment just edged above 4%, but the inflation is still below 4%. So those economists from the 1960s would be thrilled at this particular point in time.
Yeah.
There's a lot of hand wringing going on right now that's probably unwarranted.
Well, these tariffs have certainly thrown some sand into the gears of a pretty well-oiled trading machine. And when I say trading, international trading machine. But it hasn't blown the machine up yet. I mean, we haven't become so balkanized that we're only dealing within our own borders. And Europe's only dealing within its own borders. And further to the point, France is only dealing in its own borders, and Germany's only dealing in its own borders. When you get to that extent, that's when costs do get out of control, because not every country is blessed with all the ingredients they need to make a modern life function. So you're going to have to import stuff from somewhere. And when you do that, the costs in that sort of a world, trade barriers are extremely high, and thus costs are very high. So we've thrown some sand into the gears, made it a little bit less economical to live, a little less. Goods aren't going to be flowing as freely as we recently remember, but costs are not going to necessarily skyrocket because of them. And again, we must always remember, what's the effective tariff rate, not what's printed on the front of the newspaper or on the screen. That's enough to scare anybody 24 hours a day. But what's the effective tariff rate that we are really going to be paying as a consumer?
So the fact we're almost through our hour, I wanted to go back to the alphabet riddle that I brought up earlier today, wondering whether a Y tariff has two F's in it. And some people might have thought I was going to grade the tariffs on a scale of A to F. I'm not doing that at all. I think what the tariffs have done is create a lot of friction in the economy, and the only thing that's going to determine how we do it is what happens in the future. So those are my two F's to notch off the 5 o'clock hour and start the cocktail hour. Any questions? Gail, would any questions come in the last half hour?
No further questions.
Anybody else? Peter, do you want to make any concluding remarks?
No, I don't think so. I think we summarized it all. Our current situation is certainly one which is, I don't think absolutely ideal, because we're not allowing economies to function at their highest level. But there are some points to be made with regard to reshoring some important manufacturing, such as we do not have any capability in this country of building ships. All our shipbuilding is done overseas in South Korean or Chinese yards. And I think we've rightly determined that we need to have that capability back in this country. So again, there are takes and puts. There's some sand that's been thrown into a well-oiled economic international trading machine, but there are points to be made on the other side. Yeah, I'm throwing some sand in the gears, but maybe I'm reshoring some important manufacturing. So far, American companies have been able to cope with this situation very nicely. So far, the American consumer has been able to cope with the situation very nicely. We think it's going to continue. So I'll end on that.
Before we close, we do have a question from Liz. Liz wants to know, why do you think the news is emphasizing the gloom and doom? No positives.
I'll use one quote that our learned client Matt Kerbel used, and if it bleeds, it leads. And bad news does sell much more newspapers than good news.
I agree. So thank you all very much for your time and your interest. Call us at any time.
See you next quarter.
Bye. Bye.
Thank you all.